You know, Lawrence's remark this morning got me to thinking that it's probably a good thing that Klopper didn't review my undergraduate transcript before he hired me, because I had one C, and I also went to Penn State, and I had one stinking C, and it was in econometrics. And the story goes, it wasn't so much that I didn't understand the econometrics, but being a 21-year-old college senior, I was embarking on irresponsible and risky behavior, of course. I was trying to date two women at the same time. Never again. Never again. It was a mistake. So, and my C, every time I see that C, I think about that. So, let me make a couple remarks. I will say that when we started formulating this forecast and looking into 2014, especially 2015, it was the first week of October. And as you know, things looked pretty scary, okay? And I was very, very pessimistic and worried a lot that this would be a multi-quarter event. And even if we kind of got the government going again, lifted the debt limit a little bit, we'd run into the same thing in January, February, March, whenever it might be, and that this was really going to start taking a toll on growth. So the forecast still has kind of some of those remnants of being pessimistic. I will say over the last week or two, when you look at data, things look better. When you look at the political environment, and I hate to use the cliche that you've heard over the last week, but I think it is apt that, you know, we've made some baby steps forward, and, you know, in the sense that this deal reduces the hurt in the short run and kind of pushes it off to the longer run, and that's kind of the way people want things to do. So I think there's some room for optimism going 2014. If you really want the optimistic forecast, I noticed my colleague Dan Bachman has a forecast out there, much more optimistic than mine, especially in 2015, 2016. And of course, we can investigate more optimistic forecasts as well. But I'll still say and show you why I think these green shoots are still a little bit, you know, tough to hang your hat on, and I'll show you why. So for example, employment, this is the graph I always lead off with. I was thinking I'd do something different, but it always tells a good story that, you know, 200,000 a month, love it, you know, make it 210, 250, but it's still in terms of percent of the labor force compared to last year, percent of employment compared to last year, it's still pretty slow growth. It's still pretty slow growth. And I guess especially, as I'll show you, in contrast to other recoveries. So we still have somewheres to go. And to really give you the feel what's going on, despite optimism, I can show you the U.S. economy in three graphs, okay? First of all, if we look at GDP versus potential, okay, and this is the CBO potential, which is very similar to ours, that at the trough of the recession, we were 7% below potential, which is, I looked and said, well, you know, the 82 recession was a bit deeper, okay? We actually came closer to 10% below the potential at that time, but we're just crawling back towards a potential, which, by the way, and we'll talk about this in depth a little later, has been discounted, has fallen down from what we would have thought before. So there's still a lot of slack in the economy, at least if you buy this kind of the way macroeconomists like to think about it, the way the CBO thinks about it, and so forth. Labor force participation, okay? So the one thing that we talked about is all that unemployment, and then, you know, there's several layers of unemployment that you can strip by, but in the end, we are employing a lot lower level of the potential labor force than since 1978, since the baby boomer women started coming in to the labor force and force. A lot of other good things happened perhaps between 1978 and 2000 that brought people into the labor force and working. And obviously, the more people you have out there working, the faster you can grow, the higher the standard of living is. And that's really fallen. And frankly, it hasn't seen much in rising, okay? And the problem here is if this stays down low, this low, can you get back to the potential? And so that's another question. And then finally, and this is the big one, inflation and interest rates. Okay, so inflation, as we know, that's the red line, is finally back up to something like 2%, which is, I'll argue, not enough, but that's the target rate. But we went through several years when it was, threatening deflation. And I don't know if we're out of those woods yet. And of course, from the interest rate side, interest rates are stuck at the zero lower bound, which, as far as I can tell, and I Googled this, is the lowest rate since loans were invented. Okay, because so far nobody's figured out how to charge somebody negative interest on a loan. And as we are, and I think that zero lower bound, that zero interest rate, tells a very important tale, and I'll talk about that. Now, the good news, and there is good news. For one thing is if you buy, and I think this is pretty evident now, that the recovery has been subdued. First of all, that the crisis was so large in terms of fall in output, and the recovery has been so slow because not just consumers, but businesses, and especially the financial sector, was so over-leveraged. Good news there is that leverage has come down quite a bit, okay? I'll show you a little bit about that. So we're getting to a point where, you look at the loan, the liability ratios of businesses and consumers, and they're down to something like, not just before the crisis when they were very elevated, but actually down to 2000 levels and even mid-90s levels. So that's good news. That the deleveraging, maybe some more to do, but it's coming down. Private business has been piling up the profits and sitting on them, okay? So they're looking for opportunities. They're getting those 0.1 interest rates, same as you in your savings account. They're looking to deploy that. They just need to get an idea where to go with that. As Dr. Yoon, as Lawrence mentioned today, we've got all this pent-up demand for housing. We've got low inventories. The housing recovery, even with higher interest rates, should be fairly sustainable. Now, it's not going to come roaring back. It may not pull, housing always has the potential to pull a lot of other sectors with it, like appliances and, the construction workers will go out and buy cars and so forth. So that's good stuff. We're not going to see, as Lawrence said today, we're not going to see going back to the boom years. But if we got to 1 million units in housing, I think everyone would say, wow, that's a pretty nice level. That's going to do a lot for us. Energy production increases, interesting. Already covered that as well today. And I think that's very, very significant, not just from a kind of a short-term aggregate demand, but I'll argue later from a long-term supply side view. That's a very important item. In 2014 to 2015, especially 2015, and the next year, we should start seeing exports of manufactured goods and crops as well, agriculture, beginning to accelerate, okay, beyond the 3 to 4% range that we've seen now. Granted, if Europe recovers, we're not going to see 2.5%, 3% growth in Europe, but heck, 2% growth in Europe is pretty good, okay? China can avoid some of its problems, and then, there's still a financial overhang over the emerging markets. Skate by that, we should see exports going. Moderation of the sequester. So, going into next year, we were looking at another very, very significant cut in discretionary spending if the sequester was let to ride, which, as we know last year, probably at least trimmed 0.5% of growth in 2013. maybe a little more. Probably trimmed 500,000 jobs formation in 2013. Were we willing to do that again in 2014? And frankly, the hit was potentially bigger only because a lot of the reshuffling that you folks did in terms of funds, you couldn't do for a second straight year. So potentially that was a much more dangerous thing. But you know, a lot of that's been pulled out. And so hopefully the fall of government spending will be a little lower than it otherwise would have been. And even, you know, again, these baby steps, for the last 2 days, the political environment looks a little better. But, you know, whether that'll last through the holidays is not likely. And finally, those of us that have been arguing for fiscal stimulus, and now Martin Feldstein, you know, is talking about, well, we should spend $200 billion more on infrastructure as soon as possible. You know, I was not as ambitious. I was saying $100 billion, at least from the federal side. Now, a little bit of sentiment, maybe we can go that, because infrastructure is badly in need of some rebuilding. So there's a lot of good news coming ahead of time. It may not be showing up in my forecast yet, but we'll see. So here is the overview. So next year, we're only looking at 2.6. So we're a little bit now on the low side of the blue chip. The most recent blue chip, though, was only, I think, 2.7. So just a little bit down. Where I think we're probably going to be finding ourselves falling behind the mean more is in 2015. Dan, what do you have for 2015? Do you remember?
I think it's 3.6.
3.6. Do you know what you have, Dan, for 2015?
3.2.
3.2? Okay. So 2.9, 3.2, and of course, you know, it's a whole year ahead, so those are all about the same forecast. But, you know, so it's these outer years. So the question is, do we finally see what we would call recovery speed rather than sideways speed? I always talk about, you know, if you think potential growth, and we might be on the low end, but again, close to CBO. If you think potential growth is 2.2, 2.3, then 2.2, 2.3 is sideways, okay? At least compared to what you would expect out of recovery, which is accelerated growth for a while. 1.7 is losing ground, frankly, and that's what we did over the last year. But pacing that is, well, housing is coming back, you know, but double-digit increases in housing year in, year out. You can need about 4 of those to get to your 1 million units a year, right? Exports, you know, not doing too bad. Government's still contractionary over the next several years. So next year, another negative. This is in real terms. So you can grow the nominal a little bit, but once you adjust for inflation, it turns negative, okay? And it's been a rough year here overall, and that's Fed plus state. At the federal defense level, I think it must be in the literature a little bit, I think we're down negative 8% or something like that this year, okay? So government is still a bit of a drag. Inflation's still well contained, so that's where I really differ with Lawrence. Actually, our consumption deflator, this is where we think that, you know, a little bit of excess money in the system might, but 2.6 is hardly a big deal, although the CPI deflator would be about 3 or 3.5 on that, okay? From the supply side, and this is kind of probably more relevant in the longer term, so we're a little higher than other people. By the way, I meant to pull this table up, and I never did. A very interesting place, if you're looking for the long-term forecasts, is each year in the Annual Energy Outlook by EIA, they have a table of various people who are, well, I don't know, maybe it's silly or maybe it's just daring to forecast out to 2030, 2040. So there's a select few of us. But it's interesting to see the differences in those forecasts, which, frankly, aren't differences at all. If you think the difference between 2.9 and 3.5 in 2 years from now isn't much of a difference. 2.3 and 2.4 in the long run isn't much of a difference. So that's kind of where we are in the long term. And of course, why do we do this? We do this for a lot of the other work that we engage in the sense that setting the baseline is just something you do for the experimentation of variations, okay? However, I invite any of you to meet me back in 2040 and say, Jeff, you were wrong. I'll buy you a beer. Okay. Unemployment falling slowly, interest rates gaining ground very slowly as well. So the Fed has pretty much told us that they don't like sideways. They want to see a recovery, and they will, at least at the interest rate level, keep that quite low for some time. And then again, on the current account and the federal net borrowing, we have, as a matter of course, to set up that baseline, we want those becoming sustainable in the long run, okay, and not blowing up. You may believe something different, but that doesn't, when I want to do my experiment on fiscal policy or something like that, I want something that looks sustainable to start with, okay? Now, so monetary policy quickly. How has monetary policy affected this expansion, recovery? Well, not very much. So I did it a little bit different. I had been putting the Fed balance sheet there over the years, but the other way to look at this is how we model such things. Typically, you modeled a two-step process. So monetary policy goes through the money multiplier. So the money multiplier is the monetary base, and if you expand the monetary base, how much does M2 go up? And as you see that it did fall. It's got an interesting historical relationship, which might have much more to do with measurement. Flat, and then it falls off the edge. So the extent that the Fed is, as people say, printing money, it seems it's not going anywhere into the greater money supply. It doesn't go into M2. Now, to the extent that they do get M2 going, what happens from there? Well, MV equals PQ, one of the 3 things you need to know about economics, right? The quantity theory of money. And MV over PQ assumes that V itself it might move around, but it should be stationary. But as we see that the velocity has also fallen in this recession. So that's what a liquidity trap looks like to me, okay? So I think we're still stuck in a liquidity trap. And in a liquidity trap, monetary policy is just not effective. And I think that's where we're stuck. Now, the one thing that quantitative easing has done, the one thing that low interest rates has done, have kept asset values up, okay? Have kept asset values up, so our wealth is not falling. If our wealth was still falling from 2009, 2010, 11, we probably would have been in much worse shape back into the Great Depression. Although, frankly, by a lot of measures, especially in Europe, the last 5 years have been worse than the first 5 years of the 30s, especially in Europe. And even in the U.S., industrial production, these types of things, we experienced, something that was similar to 1930. Nonetheless, is quantitative easing blowing bubbles in the asset market? So you be the judge. You're the ones putting money into your TSPs and 401ks and buying stock funds. So this is the Shiller irrational exuberance data, okay? And so this was what led him to believe in stocks. The blue one is the price-earnings ratio. His proprietary one, which, it does a lot of neat things to it to get things. And of course, if you had that in 2000 or 1999, you would have pulled all your money out because that time wasn't different. But now we're up to 25 in the U.S. today. Does that look bubbly? Well, certainly compared to 2000 standards, no. Even compared to 2006 and 7, no. But, it is on the high side, and I believe the long-term average is about 15. So Shiller, again, says, well, I don't see that exuberance mentality out there, but you never know, okay? Now, the other one, of course, is the long-term interest rates. And there, well, you know, you could argue that that looks pretty bubbly, these long-term rates being so low. So typically you hear if you're surfing across channels, because anybody that really stops and see NBC, I don't know why, but typically they'll tell you that there's no future in holding bonds. Bonds prices are going to fall, and you're going to lose a lot of money. But how many of us really invest in bonds for yield? We're doing it as a hedge against this kind of stuff, right? Or a hedge against war in the Middle East and that type of thing. That's why you hold bonds, not for yield, even though you may lose some money. But nonetheless, you know, when people talk about an asset bubble from quantitative easing, they're really talking not so much about the stock market, but the bond market. Okay. The perils of tapering. You know, when I read stuff about this, the thing that people are really worried about is emerging markets, right? That the money starts flying out of Brazil and Mexico and all these places where we've put money in to chase yield. That may be the big problem. And if you remember the last crisis, in the Asian crisis in the late 90s, is that really benefited the U.S. in terms of growth because all the money came flying back in here. So that's one thing to think about. But on the other hand, get back to the bond market is tapering. You know, I think that term was but intentionally chosen to give you the impression, oh, we can do this nice and slowly and gradual. And so when's the last time you ever saw a financial market act gradually? So I think there is a bit of a worry there on this tapering, this pulling out, that there might be a problem. The Fed tells us that the Bernanke speech, I think some of you were there, he did a speech about a month ago now at the NEC and talked, you know, he said this is a failure to communicate. The June wobbles in the markets was a failure to communicate because there's a lack of understanding among, not economists, of course, but market commentators, the media, and congresspersons, that we never said anything about interest rates. Interest rates, we've been telling you for years, aren't going to budge until we get, you know, closer to 6% unemployment. We're not going to do anything with interest rates. The quantitative easing is another thing. And I think that was his point. I don't know how quickly we can increase the understanding of media commentators. I think we've been trying for 100 years and hasn't worked out so well. But there are perils there. So if monetary policy is ineffective in a recovery, especially at the zero lower bound, what about fiscal policy? How's that working out? Well, it's pretty effective, especially if you want to contract the economy by cutting back on government spending. So this is real Fed plus state and local spending after the last 4 recessions, okay? The blue line is the great Keynesian Ronald Reagan. Steady fiscal stimulus helped us recover from the previous difficult expansion, okay? The yellow line is the 1991 recession, so Bush-Clinton recovery. At the beginning, pretty expansionary, okay? The red one was the other expansionary after recession, to 2001 recession, again, steady increase in government spending. And then the last one's the 2009 recession. Steady, especially after a year or so of government contraction. So when I hear people talk about the failed stimulus, it drives me nuts because we didn't stimulate, through spending anyway, fiscal policy. Now there's a tax side too on this, right? And that's not here. But, you know, those Keynesians among you might think that, you know, the spending side is better if the idea is to get from a big trough. Now, the next one, though, is kind of interesting as well. And this is the GDP recovery after those same recessions. So the fiscal expansion among other things, from 1982 on, was pretty effective in getting the economy to bounce back, okay, in 1982, 83, 84. The other three, or the yellow and the red, the GDP recovery was a lot more muted. Of course, the fall was a lot smaller too. So if we had a bigger picture, we might go back a little bit and show you the troughs as well. Those were lower troughs. The 82 was a big trough compared to the red and the yellow. Of course, the green one was the biggest trough, right? So that was the one, well, actually, I just said that 82 was 10% below potential, but it bounced back quickly. We got to about 8% below potential in 2009 and bounced back slowly, and you can see that here. So this recovery has been relatively low. Why? Well, you know, two graphs do not a case make, but I think of a lot of other cases and a lot of other papers that have been written that says you don't cut spending when you're trying to recover from a near depression event, okay? And all you got to do is look at Spain, Greece, Italy, okay? Employment recovery. This one is even the most, I think, interesting and perhaps concerning because the economy was quite a different animal in 1982. And the recovery not only pushed GDP up, it pushed employment up quite rapidly. The last three have seen, if this is the recession trough in terms of GDP, you know, employment fell a little bit in each one of those, and still it took almost 2 years to start growing again, and even the most recent one has seen better recovery than the 2001 recession. So what you're really seeing there is, in the business cycles over time, the employment bounce back has been kind of falling. You know, the great American jobs machine, something is sputtering there, right? Something is sputtering, and that's kind of concerning. Okay, short-term policy options. I kind of go through these, so let's skip that quickly. This is kind of things I was talking about now, is that people's net worth is looking better, especially the red line. So we had the big drop in terms of absolute value in dollars. The net worth is $77 billion, which is a bit bigger than it was in 2007. But note that most of that is because of financial, and especially the stock market, okay? And of course, most of that is concentrated at the top 10% of the wage earners, of the income earners. Home equity, and it's interesting, you all know how to manipulate, or not manipulate, well, of course, if you want to manipulate, but how changing the scale makes things look different because Larry had this one earlier today, and home equity is inching up. Okay, but still quite lower than here, and even quite lower than here. And this is what the other 80% in terms of wealth live off of, is the home equity. So at the bottom, we're still not quite there. Now, what's more significant, though, is this one, is household debt service. So, you know, let's be honest, a lot of people were concerned about this type of stuff in 2005 and 6. Okay, economists were like looking at this and say, boy, this is a big problem. Now we're back to, and this is 10%, so you have to pay 10% of your income each month on, I think it excludes your mortgage, but everything else, all your revolving debt, student loans, everything else is in here. And that's down to 10%, which is a lot different than 13%. So that area is where, you know, I say the deleveraging, and you can look at other deleveraging or leverage measures and see some good stuff there. So the consumer household sector is in a lot better shape than he was back then, although his income hasn't grown very much either, though. Okay, Europe, and I think we were a little more pessimistic last year, but you are seeing some growth there. And as I said, you know, 1% may not be all that great, but I mean, going back to that's all they average in total. Remember, the population of these countries is really either growing extremely slowly or even falling in some cases. So on a per capita basis, frankly, 2% in Germany looks a lot like 3% in the United States, right? So that's not so bad. So hopefully this continues. Japan, a little bit of growth there. Korea, a lot of growth. China, a lot of growth. So the world is starting to perk up only because it's been beaten down for so long. It's hard to keep economies down. Unit labor costs, these are the OECD ones, but you can see Canada, Germany, Japan are major trading partners, except for China. So China one is really hard to find. The BLS used to publish a China unit labor cost, and they stopped doing it because it was just hard to do. But vis-a-vis our major trading partners, ex-China, we're the blue line, this light blue line. So we're pretty competitive. You look at the World Competitiveness Index, the U.S. is still a pretty good place to do business. So if demand arrives, I think we can play in that place. Okay. Now, healthcare. Can't really do much these days and not talk about healthcare. Fortunately, I know a lot about it, but who doesn't anymore, right? Who doesn't anymore? But one thing is, I'm going to test you guys, is one fact is that healthcare expenditures have grown slowly since 2007. In fact, healthcare expenditures for the last four years running, 1, 2, 3, 4, have grown slower than at any time during history that we started measuring this in 1960. The blue line is healthcare growth in nominal terms, expenditure, and it's been stuck on 4% per year for 4 years. And by the way, that's about the same as GDP. About the same as GDP. Now let me ask you a question. How many people knew this? How many people knew that healthcare expenditures have been at historically low rates of growth for 4 straight years? Okay, so about half, okay, which is not a representative sample of the community as a whole, but that's kind of a very interesting prospect. Now, next question is, and this is especially important to Sean and Todd, the guys that do these forecasts. How many of you expect that this is continue over the next, say, 10 years? How many? Come on, don't be bashful. Okay, interesting. Okay, so Sean's right. Good, Sean, I'm glad. At least according to this community. Okay. We can decompose this a bit and say, and you can study this at your leisure, but one of the things that's interesting is both healthcare excess, what we call excess healthcare inflation. That is the increase in healthcare prices vis-a-vis the increase of the GDP deflator. That has fallen. Okay, it used to run at about 1, so if GDP deflator is going up by 2, healthcare prices would go up by 3.4 or 2.7, but now 2.3. So that has fallen. The excess inflation has fallen. But also what we call the excess real expenditure has fallen. It used to run, if real GDP was going up by 3%, it would go up by 4.2 or 4.4. Now it's actually, over the last 2009 to 12, and that's growth in 10, 11, 12. This is actually only 3 years here. It's actually fallen. So the volume of expenditures has fallen relative to GDP. So this is interesting stuff because, as you've heard, perhaps, if we bend the curve, if this was to continue, then that whole entitlement problem that we talked about this morning is not a problem anymore. We have cracked the code, as they say. Maybe you have to go to your basement and get a beer. Maybe that's what that happened, is the code has been cracked. Have we bent the curve, as we say? Well, the CEA, Council of Economic Advisors, about 2 weeks ago, or maybe within the last month, came out with a report that looked at this, especially relative to the Affordable Care Act, and tested the one thing that comes to mind first is, this is a figment of the recession. People lost incomes, so they're going to spend a little bit less on sometimes a luxury good like getting a tooth replaced. But also people were losing their jobs. They were losing their job-based insurance, so they would put off care because they didn't have the insurance to pay for it. And certainly that's got to be a big factor here. So people were going to the doctor less because they didn't have insurance and that type of thing. And then, of course, once those demand pressures fall, the providers supposedly reduce their prices. Now, I will say one of the things that the CEA points out is saying, aha, that sounds plausible, but yet we've seen even a bigger decrease in terms of the excess cost in Medicare. And of course, Medicare should be somewhat insulated from the recession because people aren't losing their insurance, and it really doesn't matter what their income is. So something else going on. Another thing that's gone on, as most of you know, is a significant increase in cost sharing. So your employer comes back and says, oh, same premium this year, bigger deductibles, bigger copays, okay? Or your premium goes up if you want to buy the same deductible, okay? So that's been going on, and that preceded the Affordable Care Act. It's really been going on for several years. Now you have employers that are saying, oh, we're doing this because of the Affordable Care Act, which is nonsense, but they're saying that as an excuse. But all along, of course, the economists have been sitting there, the way to crack this nut is to make consumers pay a heck of a lot more for health care. So we've done it, and it seems to be working a little bit. Generic prescriptions is a big part of this. So if you looked at the different expenditures and where it's really been following, prescription drugs. So sell your drug stocks, right? Because that's really a big part of it is massive shifts to generic drugs. Another area. Structural changes in the private market, kind of the cost sharing, but other things, the consolidations of hospitals, at least for a while, create cost savings. Okay, in the long run, the economist in you says, consolidation doesn't sound like a good idea to keep costs down, but at least in the short run it might. So things have been happening. Medicare, Medicaid changes that were independent of the ACA, and some, of course, this trend started in 2007-8. The Affordable Care Act was passed in 2010. Its stuff trickled in. So the CEA kind of wants to say, oh, that's the ACA. And there are a couple things. One of them is this. The ACA started penalizing hospital readmissions. And guess what? Hospital readmissions have fallen. So, again, the economist says, oh, you mean healthcare providers respond to economic incentives? Never knew. But that's what's going on. So this is part of the story as well. So there's good things going on, but whether that's a permanent thing or even a permanent, there's slope changes and intercept changes when you talk about the curve. Some things we could do more efficiently might change the intercept, doesn't change the growth. In the long run, we need to change that growth if your objective is to get the excess costs down, okay? And that's, frankly, I find that debatable, but that seems to be what everyone wants to do, okay? So, but we are in the process of this healthcare reform, and I would like to announce I'm going to run for president, and my healthcare reform plan is going to be this. If you have an insurance plan and you like it, that's got to stop. We can't have that, and I'll explain what I mean. That's the problem. Too many people like what they have, okay? And really, the problem with insurance reform is you've got your insiders and your outsiders. And God forbid you tamper with the insiders, because that's political difficulties. And frankly, when you look at a lot of our policies, it's an insider-outsider problem. So what do I mean by that? The one thing about Obamacare was that we started with, this is non-elderly population, so Medicare is kind of out of this. 56% of us in 2012, before this stuff came down this year, were covered by our employer, right? And boy, what a nice deal that is, okay? Because for one thing is, I'm covered by the state of Maryland, and I am paying for maternity care. I'm paying for all those types of things, but I don't know about any of that because, the University of Maryland, well, actually, in my case, Inforum, but the University of Maryland is paying for a lot of that, $12,000, say. They're paying for that premium, and not only am I not seeing that in my paycheck, it's tax-free. as Jane Marie talked about today. That's all tax-free. So I'm getting this huge government subsidy, and a lot of people object when I say this, but it's a huge tax subsidy that, by the way, varies by your income. So, you know, this system is really nice for the insiders because it says, not only do you not know what you're paying for insurance, but we're going to subsidize it through taxes, and the richer you are, the bigger your subsidy. You know, so that's our system today. That's our system today. So we couldn't, you know, when Obama was running on this, he couldn't say, oh, we got to change it. I will say that in 2008, John McCain did, right? And John McCain, that was his platform, was to remove this tax bias and get everyone, you know, to level the playing field, because the problem now is you've got the private non-group. So if your employer didn't cover, you had a choice. You could go uninsured. If you were poor enough, you could go on Medicaid. You could be uninsured, or a small portion of those people said, I'm going to actually go buy insurance. And if you could get it, you know, if you had some kind of health condition, maybe you couldn't get it. But Obamacare said, oh, okay, what we're going to do is try to insure all these people, and maybe we'll split this roughly about 50-50. We'll throw the poorest people back into Medicaid, and we're going to take really about, what's that, half is, say, 9% of these folks and throw them in the pool with the 6% here. So this pool was going to become contaminated, if you will, with a bigger pool of uninsured people. Now, the hope was that a lot of these uninsured people were healthy and young and would subsidize the group. And then, of course, we went from individual ratings to community rating as well, which was caused some problems. So the result of this, or the uproar over the last couple of months, when people kind of realized what was going on, is that in the end, I think it's very, very clear that it's very hard to deal with these folks without pulling these folks into the mix. Okay, you got to pull these people into the mix. So what would that type of reform look like? Well, fortunately, we have folks at the American Enterprise Institute, because apparently we don't like their first version. American Enterprise won because that's Obamacare. So they have new stuff, and this is good stuff. And my friend at the Mercatus Institute, Bob Grabois, is also very nice. I give you the quotes there. Very nice proposals for what a more effective health care reform would look like. And the first thing, as Jane said, separate the employment from health insurance and defragment the market. So make that pie into one pool by removing the tax bias for employer-provided insurance. Okay, and believe me, this footnote was there long before Jane had mentioned this morning that the tax deductibility of employer-provided health premium is quite possibly the stupidest law in the land. Okay, because this is our problem. This is our problem. Okay, and then you go, we need to promote more market-oriented and patient-centered approaches. We need to have a national exchange. If you like the exchange we got, healthcare.gov, we need to go big time on that, okay? And have an exchange where everyone can buy their insurance that way, okay? And believe, these are the conservatives, right, that say to do this. Increase cost sharing even more. You can tell these are economists designing these, right? Allow premiums to vary based on health status. So this community rating idea, this is what makes people mad, because I'm healthy. Why do I have to pay? I'm a healthy male at 25. Why do I have to pay for maternity benefits? Okay? I shouldn't have to pay for that. I shouldn't be in that pool. Okay? So we can do this. Women should pay more for health care than men, right? That's the way an economist would do it. Okay? Age, gender, etc. Okay, now, if people have a health condition and they're poor, oh, well, the federal government can step in and determine who is needy and who is sick for that premium support, okay? Again, these are the conservatives. That seems to me to be a very, very big federal input into the system. Increase it, now, a lot of these things are good. I really, I have the quote. Bob Grabois' article is very, very good. There's a couple other things going on that you might know about. Recently, Mercatus did a op-ed about the monopoly certification rules. I guess they call them certification rules. We would call them monopoly certification rules. So if you want to invest in imaging equipment in Northern Virginia and set up a string of healthcare centers to compete with the existing people, you have to go to a board of the existing people to get permission to do that. I mean, who would design such a thing? But we got to do stuff like that as well. So there's a lot of good stuff in here. As an economist, you know, I kind of buy into this. Okay, now go out and sell this to the American public. Okay, so that is the problem, right? That is the problem. How do you sell something like that to the American public? I'm not so sure that you're going to get anywhere with that. And here's our different further readings for homework. There'll be a test next year when you come back. Okay, how are we doing here? We'll turn to the long term a little bit. I got about 10 minutes or so. So now, after 5-6 years of this kind of going sideways, a lot of economists are very, very concerned that we may be dealing with a new animal in terms of the economy. And this affects what we're seeing in the long term, okay? You know, one of the things we talk about is the hysteresis from the Great Recession, this labor market participation, that long-term unemployed. How many of these people are ever going to get back to employment? Are their skills degrading? And in the end, the question is, you know, has our potential level of GDP degraded? And we'll talk about that. That's a kind of a changing in the intercept. I'll show that. Secular stagnation. So this is, Larry Summers came out last month at the IMF and says, you know, I have another concern. I have a concern is, you know, no matter what potential is, we may never be able to get there because we have a chronic shortage of aggregate demand, okay? That at the zero lower bound, you can't push real interest rates low enough to get aggregate demand enough to get back to potential. So there's a concern there. And then in the long term, Robert Gordon has talked about technological stagnation, that a lot of the technologies that we rode in the late 20th century are over, have exhausted themselves, and now all we got are these darn phones that are supposed to increase our productivity, okay? The ICT technology, which we're seeing now, is not enough. So let's look at those types of things. Things that, factors that might fit is the debt, okay? Does high rates of debt slow growth? Unequal income distribution. Does unequal income distribution, which seems to be either a side effect or part of this, does that retard growth? Do we have an entrepreneurial crisis? And finally, the political dysfunction. Does rent-seeking and Olsonian decline, is that what we're dealing with? So what I mean by Olsonian decline is Mansard Olson, who was a professor here at the University of Maryland, I think Chuck did his dissertation with him, you know, wrote The Rise and Decline of Nations and said that, you know, when you start getting society segmented into different interest groups that lobby the government, you're always going sideways. You're never making these insider-outsider choices. Okay, you're never displacing the insiders. And this type of gridlock where you have the tax preference for employer-provided health care won't go away even if the economists wanted to. And that's the type of thing. And then the funny thing about Mansard says, you know, where economies start growing is after something comes through, like Japan and Germany after World War II, and just wipes out the existing institutions, and you start with scratch for new institutions. So that's a pretty alarming message. So let's look at that a bit. This is what I mean by the potential GDP. So I went back and found out what our potential GDP was in December 2007, and it's the red line. Okay? Now, our potential GDP now is the blue line as of today. Okay? So this difference is what we call hysteresis. It is, now, you know, this is notional because these aren't real variables. These are variables in our head. But most economists have these variables in their head and said that the long-term unemployment, the lack of investment, so we've lost all 5 years of a lot of capital investment, degradation of human capital, all kinds of things, means that our potential GDP is actually lower now than we would have hoped without the crisis. So and most of this hysteresis is because of the crisis. Okay? The difference between the green line and the blue line, see, we are now forecasting, it takes a long time to get back to potential. Danny gets back quicker. So does CBO, for that matter. So 2016, 2017, they've closed this gap. But this is what Lawrence Summer talks about into being the, what happens if the green line never reaches the blue line? Could that happen? Could we go sideways for a decade and never catch up? Well, it depends on your model, because most models would say, oh, well, if that's the case, then the blue line's got to keep coming down, okay? So that's kind of where we are with this thinking. And to put it another way, the GDP gaps, the difference between the lines is the red line, the difference here is the hysteresis. That is the, if potential GDP did not change because of the crisis, then we're now close to 10% below potential. But we've assumed here that the potential has degraded, so we're really only about 5%, okay? So that means we've given up, perhaps permanently, 5–6% of income. 5–6% of income is the hit on that the Great Recession gave us. Now, don't take my word for this. Very good paper coming out of the Federal Reserve Board, aggregate supply in the United States, recent developments and implications for the conduct of monetary policy by Reichstein. And it's kind of interesting because they work for the Fed, and so it's all couched in monetary policy, but if you read between the lines, at least if you're me, reading between the lines, you're saying, the failure here was not to use fiscal policy when you had a chance to keep up potential, okay? I think Ben Bernanke would tell you that, Janet Yellen would tell you that. They don't tell it straight out because they don't, although Ben Bernanke came close to it at the NEC meeting. The failure was not using fiscal policy when we had the chance, and in the long run, and of course that's my view of the world. You can differ, but now, the debt check. So we talked a little bit about this today, and Dan, as I pointed out, our gross debt is not over 100% of GDP. It's 99.1 because BEA revised the denominator upward, and so it fell, okay? So really, the solution to our debt crisis is for BEA to revise GDP up again. But here's the net debt, okay? Notice about a little less than half now we owe to foreigners, so a lot of it is owned to each other, okay? To each other, U.S. residents, more than half now, okay? And then the green part is what Dan was referring to is the Social Security, Medicare, and pension trust funds, okay, which are in a safety deposit box somewhere, including retirement, federal retirement, okay, and we're about up to 4.7 trillion there. So you're adding, going from 79, almost 30% of GDP there. And this is kind of what people look at and say, oh, is this going to be a problem? Is this going to be a problem? Or you could go a step further and say, by the way, that 6%, keep that in mind, okay? Because really when people look at this, they worry, oh my gosh, no, wait a minute, I subscribe to the Social Security and Medicare trustee reports each year, and they have a number in there with the net present value of all the unfunded liabilities, the things we owe to each other that are not in that safety deposit box are actually much larger. Okay, that's Medicare, about 40-some trillion. Social Security is quite a bit less, but when, that disappeared. This was all the federal pensions? I'm sorry, we lost that. I didn't do that intentionally. But that's the easy. I put it by the ease of fixing them. The easiest way to lose 10 trillion or 9 trillion of this now is to eliminate the pensions. The Social Security is the next easiest. But my point being is that's, people jump up and down. We owe 60, 70 trillion. Okay, 60, 70 trillion. Okay, how much? What's that mean? What's that mean? Well, in terms of the net present value of the GDP from now until 2087, it's 6.6%. 6.6%. 2, maybe 3 years. Well, actually, this is nominal. Well, present value, real, it gets a little fakey, but that's 2 or 3 years of growth. Okay? So, one of the words that economists use that no one else understands is sanguine, right? So Douglas Holtz-Eakin once said is sanguine is an economist, that's as much optimism as you'll ever get out of an economist, is when he says sanguine. We don't use the word optimistic. Dan, I'm more sanguine about our ability to service this than you are. I don't think it's as big as a lot of people want to put out. It really is a matter of raising the government revenue percent of GDP from, say, 21, 22% to 25, 26%. So 3% a year, something like that, okay? Ongoing, it means higher taxes, but it matters how you collect those taxes as well. So if you're doing it all on the soaking the rich, you know, the danger is the marginal rates go up so much that you do retard growth. But if you do it on consumption taxes, and sorry, John, energy taxes, okay, it really, those can be efficiency enhancing, okay? If we tax video games, that would be a good thing. So I'm actually a lot more sanguine about entitlements. And also, the other thing that I worry about is the following. So if you look at the ideas for just, and I won't even touch Medicare today, we've already bent the curve, so Medicare goes off the picture, right? But with Social Security, what worries me about means testing is, here you have folks, for one thing is, and I'm sorry that Jane's not here, I think the defined contribution experiment has been a complete failure. We've got 50% of people within 10, 15 years of retirement that have no savings. No savings, okay? What are we going to do about them? So they'll go and they'll collect their Social Security, maybe that's 30 grand a year, and then you say, oh, guess what? Medicare is more of a premium support system, so we need a $10,000 premium off of your $30,000 to live off of, okay? So my worry is that a lot of this stuff that we would like to think we can do to reform retirements are going to be, put the politics aside for a minute, but even from an economic point of view, are really going to be difficult to do. And that's my worry. I actually think it's easier to raise the darn taxes because this is going to be very, very difficult. Okay, now, let's pass that one up. Okay, but if all the things that worry me about long-term growth, this is the one that really worries me, and it goes back to the John Halterwanger talk we had, I guess now 4 years ago, is that net business creation in this country, sure, it's cyclical, okay, and we destroyed a lot of businesses, but look, we're only getting 10,000 new businesses, what is that, monthly? It's a quarterly number, right? So 10,000 businesses, it might be, no, it's not annualized. So 10,000 businesses a quarter, where we used to be up at about 30 when we had the Great American Jobs Machine. So where are all the entrepreneurs? What's going on? And then there's a whole literature on this. It's burgeoning. It's very interesting of what's going on. I think a lot of it is demographics, frankly, because baby boomers, I don't want to start a business. You know, I'll just ride it out on this job I got now. The other one maybe is healthcare. You know, people not wanting to take that risk, not wanting to lose health insurance. Other people say, oh, all the regulations, it's getting harder to set up a business. Yeah, that might be true, but relative to the rest of the world, the U.S. is still the easiest, almost the easiest place to do that. But that may have something to do with it. But the fact is, it's happening, and that's where the jobs come from. The jobs, as John Halterwanger always reminds us, doesn't come from small companies, doesn't come from big companies. Virtually all net job creation comes from new companies that grow. And if you're not having new companies, that's why we're having trouble growing jobs. That's what I think. And that's where we need to look and see what's going on. And it may not be a very easy thing to get over. I don't know. So that worries me, is what I call the entrepreneurial crisis. Okay? Income distribution, okay? It's the skewing of the income distribution. I didn't get to add on the extra year. That number actually jumps up. This is 2009. It goes back up. So virtually all the gains of income over the last 4 years since the recovery has gone to the top 1%. I mean, we're talking over 90%. Everyone else has gone sideways. Okay, so this is a real issue. Now the question is, and you know, some of the things that happen here, and I think this is a very neat indicator, but I think you could look at a lot of indicators and see the same thing, is everybody is doing a bit better. So this is the 1961 to 1964 birth cohorts. Okay, some of you are in that. And at the lowest quartile of income, 5% of them have college degrees. At the top quartile, 36% of them have college degrees. People born in the early 60s, sorry. People born between 79 and 82, all of them have increased, okay, 5 to 9. But they've increased much more at the top, going from 36 to 54. So when we look at our college graduation rate, it's great, it's gone up, but it's really gone up at the top, not so much at the bottom, okay? Not so much at the bottom. So there's evidence there that we may be underinvesting in education and that this could retard growth. If we become a segmented society where some people get great education and don't touch education. I mean, that's the one thing. You can have the liberal parents that say, yeah, I'm in for redistribution, just not when it comes to my kids, And that's a big problem. That's an insider-outsider problem. Life expectancy as well. So we talk about reforming Social Security, raise the retirement age. That's great, especially for professionals that can work longer, make a lot of money. That's fine. The laborer that's not making much more money dies early, okay? They die earlier than the rest of us. Their life expectancy has not risen. So does income distribution? A lot of stuff on this. So the whole Journal of Economic Perspectives special issue this summer on this. You got Stiglitz, Agnes Deaton wrote a book about this. Robert Solow has weighed in on this. All of them saying that worsening income distribution can have adverse effects on long-term growth. And partly because of the immobility thing. So that education graph shows you that inequality means immobility is harmed. And that mobility is harmed. So people are not moving up. We have this myth in the U.S. that as long as you do everything right and you go get the education, you work hard, you'll move up. Well, relative, at least, to other countries in Northern Europe, we're a lot less mobile than they are, okay? There might be a lot of different factors, but it's what we see. Now, I'll be honest with you, I don't buy a lot of these. I teach my course in development economics, and for years I've been telling the students, look, inequality by itself is not a problem. I mean, go back to Pareto. If incomes grow at the top and not so much at the bottom, you're still people better off, so you shouldn't mess with that, okay? You shouldn't mess with that. But what if the case is incomes are growing at the top and that fact is retarding income growth at the bottom and income growth as a whole, okay? And you say, well, that's not the case. But for years and years, we used to point at places like Brazil, like Mexico, okay, and say, that's what's happening there. The growth, they can't get growth there because of the rich people are doing all the rent seeking, okay? Are we coming a society like this? A lot of people are saying, this is what's going on. Is that it's, why do entrepreneurs not invest in capital equipment? Because they can make a lot more money investing in politicians. And are we getting there? I think we really need to think about that. Okay, finally, quickly. Okay, Robert Gordon's stagnation thesis is a little bit different. Intriguing, another paper, NBER working paper. He's going to have a book out soon. I'm actually surprised. This came out in August 2012, so this book must be ready at any time now. And his thesis is the following. That recent innovation just doesn't stack up to the stuff we saw in the middle 20th century. Electricity, indoor toilets. What would you rather do? If I said today, you got to give up either your cell phone, your smartphone that your face is in all the time, or your indoor toilet, which one would you give up? And that's what he asks. Which one is more important? Okay? That stuff really did wonders, and the hangovers, even though a lot of that stuff was in place by the 1950s, it carried us for another 20 years. This ICT stuff, he's not nearly impressed with. And says that doesn't promote productivity, that does not promote growth. Okay? Now, he also points to these other things, demography. These are the headwinds. So you do have technological growth. As we know as neoclassical economists, when you're a mature economy, the only thing that drives growth per capita is technology. Okay? You can't put more capital in. You can't put more labor in. You can only use technology. That's our thesis as neoclassical economists. And he says, yeah, sure enough, technology will make us grow, but on the other hand, demography, education, inequality, globalization, competing with all the other folks, energy and environment, overhang of consumer and government debt, all these things are going to put a headwind. And you subtract, he does a little model and says, okay, technology, maybe it gives you 1% per year in MFP growth, but if you start looking at these other factors, at the end, your MFP growth is really degraded because of these headwinds. Okay, so that's his thesis, and he says, oh, this could go out many, many years. So this is actually a change in the slope of the potential GDP line. So that degradation we see could go on for a long, long time. And that's his thesis. So let me end today by saying this. And so Mansur Olson's thesis looked a little bit pessimistic, that you needed revolution to change society. But I tend to be more optimistic, and I'll quote Karl Marx. Karl Marx said, capitalism sows its seeds of its own destruction. And it has a lot to do with that rent-seeking behavior and stuff like that. And when somebody asked him, I learned all this from Dudley Dillard and reading, he made us read Capital. He says, well, people say, well, why hasn't capitalism fallen already? And he says, oh, because every so often, technological change always bails your butts out, okay? Technological change always happens. Capitalism would demise if it wasn't for technical change. Well, think about it. That's what a neoclassical economist thinks, right? We'd go sideways in income per capita if it wasn't for technical change. We keep having technical change. So like Marx, I'm an optimist and really see a heck of a lot of stuff coming down the pike, okay? One of them we've already talked about today, energy. So, you know, I don't doubt anymore that the fracking revolution, if we can keep it contained environmentally, is going to make it be a big deal, okay? And energy, cheaper energy is helpful, without a doubt. Self-driving cars, you know, 5, 10 years away, just in time for my retirement. Imagine self-driving cars. It's not like this technology you see in a car today that people buy because, oh, it'd be neat to have that. Oh, I'll pay an extra $1,000. A self-driving car means that your productivity on your daily commute skyrockets. So you have to buy one. And it'll create incredible amounts of productivity growth. Robotics, big data, genetically modified crops and animals. Okay, a lot of people they get scared from this stuff. There's no doubt. But, you know, this is the way we feed 10 billion people. There's just no way around it. If you don't go with genetically modified crops, it's going to be a hard time to feed 8 billion, 10 billion people. Translation technologies, like on Star Trek, right? If you thought that the original phone that looked like a communicator from Star Trek, that was a good thing. Remember, in Star Trek, the illusion was everyone in the universe spoke English. And that was very convenient. Fact is, if you ever, I'm a real Star Trek. The very second, I think it was the second or third Star Trek, they were actually outfitted with universal translators. Whenever you had the away team, you had to take your translator with you. Because in case you encountered aliens, you could talk to them, okay? Well, they became very awkward to use and very awkward in that. So they jettisoned them all together. You never saw them again. But frankly, you know, I mean, if Star Trek was plausible, they had to have them all along. So that, I'll leave you with that optimistic mark. I don't think the slope has changed. And our forecast, by the way, doesn't show that. Potential growth, it's not huge at 2.4%. It's a little higher, I think, than Social Security. It's not huge, but of course our population is going to be growing a little lower, okay? We get this up to 3 with technological change. I think a lot of our entitlement problems kind of go away. 3, 3.5, if we could get there. But even at 2.5 and efficient taxes, I think we can handle that. Okay, so close with that. We often, I throw these in to just show you kind of the long-term types of things, to make sure the model is closing. That's how we talk about it. So the federal expenditures are going, you know, something below 2% is considered sustainable. So I'll take questions. Quick. Any questions? Peter?
Well, you had the graph where you showed in the Marxian optimism
all those innovations that were going to come. And I wonder if you could speak about that a little bit in conjunction with your natural path for labor force participation. All those things really seem to save labor, and maybe it's a normal thing for a labor force participation rate to be trending down.
You know, it's interesting. One of the things I've done recently is to restore my faith in mankind is I'm going back and reading all of my Kurt Vonnegut novels that I read in the 70s that influenced me so much. But the one he wrote that I never bought was Player Piano. So if you remember, Player Piano was the one where there were two types of people. One, if you had 3 or 4 PhDs, you could go operate a factory. And sure enough, it was about this guy that operated a refrigerator factory basically by himself. So he would go and sit in front of a computer and make refrigerators all day. Everyone else had to work. They either had to join the military or work in public works projects. So the guy would drive by, people would be filling in potholes, very Keynesian, filling in potholes and then digging it out. And in the 50s, Klopper will remember, this was a very, very common thinking that productivity would, you know, Luddite type of thinking that would create mass armies of the unemployed, as Marx did. But over history, we haven't seen that, okay? Over history, we've always seen that the productivity there generates income and demand in other ways in places like healthcare. You know, I mean, really the question about healthcare is, are we going to have enough labor to fill in healthcare, okay? Because if everyone makes money in manufacturing, okay, if manufacturing keeps driving our productivity growth and creating wealth, we're going to want to spend that on healthcare and going to baseball games and stuff. So on that neoclassical theory, that should suck up the labor. That should suck up the labor. Now, you know, strictly speaking, I think there is a lot of concern there that we may be reaching a change. I'm less concerned. I'm less concerned. I think that the increase in productivity creates its own demand. That's another thing you need. 3 things you need to know about economics is Say's law, quantity theory, money, and I forgot the other one. Danny?
Well,
No.
And yet you could, and yet you could read the recent labor market, say last 20 years of labor market, as heading in that direction where people who are less skilled have fewer and fewer places where they can go. It's harder and harder for them to participate in the labor force compared to 20 years ago. So maybe we are seeing, in fact, movement towards what would be an economy of that kind.
You know what I think is kind of interesting, or one variable we haven't talked about here, is hours worked per week. So, you know, all throughout the 20th century, hours worked fell, per employee fell. But it's been pretty flat for 20 years now. So suppose the 40-hour work week went to a 35-hour, 30 standard, like they've done in Europe to a large extent, to suck up that employment. That's a possibility to do that. Remember, Keynes always said that. Keynes said, you know, he noticed the same exact phenomena and said, heck, we'll be working 20 hours a week by 1980. Unfortunately, it didn't happen, because, you know, I'm looking forward to that, because if you all go to 20 hours a week, maybe I can go down to 40 hours a week. But that may be one of the ways of getting around that. The other one is more leisure. I mean, you know, again, the income distribution comes in here, but why do we have 2-earner households? Maybe one person doesn't need to work. Now, admittedly, that's a real cut in income, and of course, economists would say or people would say, you economists, that's the way you think, it's all money to you. You know, I work not for the money, I work for the career, and there's something to be said for that. But, you know, in the United States, we don't have a heck of a lot of leisure relative to Germany. Maybe we need to just go get more leisure. Any other questions?
Yeah.
Yeah, Nasser.
Actually, I have one question and one comment. I have one question and one comment. Someone who participated in the ARA, like we had this huge stimulus program when Obama came in, we were talking about $800 billion that the federal government pumped in. So I guess your point is, whereas the federal government did stimulate the economy, it was the state and local governments that really took it out.
That's correct.
So I think that needs to be clarified here. Now, in terms of a choice between an indoor toilet and a cell phone, let me just give you some statistics. I think the percentage in the world that has
Cell phone.
more indoor toilets is very less compared to the people who have more cell phones.
There's no accounting for taste, I guess. I will say about the stimulus, I mean, the federal stimulus barely compensated for the state and local. So at the time, there were plenty of people out there and said, this stimulus, number one, isn't big enough, and more important, has no duration. And I think I've said before here is that there's two things in January 2009 that we didn't know. One was how bad the situation really was, and two was that you only had one shot at this, that after that Congress wouldn't allow you to do anything else. So, any other? Oh, very good.